No
Okay.
problem.
So in today's class, we want to talk about internal audits, and is like a term that you would have heard of if you're an accountant that is currently in practice, at least in one place or the other, you would have heard of the phrase internal audits. So when you hear internal audits, what does it mean? Or when somebody says, I'm an internal auditor, what do you think the person's role is? Sorry, your mother, you have to engage me today because it's only you that I can find in class, but I'll try and not stress you too much. So you can just respond, and I promise I will not disturb you for like another 15 minutes. So I'm with
Okay,
you.
my
Mhm.
internal audit is what I understand is like the how strong the internal control of a company is or of a client company is.
Mhm. Okay. Okay, very similar, right? But just so I clarify, so internal audit is like a function, right? That is set up within an entity as an appraisal of their own management accounts. So it is no, no, when we talk about internal control are like the outline rules that an entity has set to make sure that the right procedures are being followed for different actions. And we're going to still do internal control as a topic on its own in this class. Okay. I'm the one that's also taking you internal control. I will do that after audit planning. So now internal controls are all the rules that are being set down by management to ensure that the right procedures are being followed. So your internal control is the acronym PAPA MOSAS, where you have your physical control, your arithmetic control, your personnel control, your authorization and approval, management controls. Okay. So your internal controls are basically rules that are being outlined. Now, what is internal audit? Internal audit is if you put all these rules and you don't put anybody or any system of verification and check to ensure that these controls that are being set up are being followed, then it is as good as those rules existing. Do you get me? So
Yes,
that
ma'am.
brings us to say that that brings us to say that the internal audit function of a department basically provides an appraisal or a monitoring system for senior management within an entity. Now, the way it works is that it is an independent objective assurance and consulting activity that is designed to add value and improve an organization's operation. Now, there are a few things to note. Internal audit is not a compulsory action that needs to be done. The way we have that all um publicly listed companies are required to audit their financial statements, at the end of their financial year, Abby, and produce a report that will be shared with management. There's no standing rule with I think it's called IIA, the Institute of Internal Auditors. There's no standing rule that says that all entities must carry out what an internal audit. So that is said that it's an activity that is being done to add value and improve an organization's operation. So organizations do it more for like being able to attract ethical investors. It also shows the auditor that you guys are prioritizing your internal reports as well. That okay, this entity also understands the need for their books to be intact even before we get to the external audit, because external audits will happen at the end of the financial year. Now, I think I've established that. So you know that it is not a compulsory function to be performed. That be, it is just out of the need. So it depends on how important the internal audit is to the entity. That is how they will want to place a level of importance on carrying out an internal audit, or they call it an internal audit function. Now, the way it works is that this internal audit can also be a department organize for organizations that are relatively big or industries that are highly regulated. Hi, Oindamola. Good afternoon. Can you hear me? Okay. It's fine if you cannot talk, you can just use the chat. So we're discussing internal audits and we just started, so you haven't missed much. Okay. So, like I was saying, just to know that what it is an appraisal, a monitoring of the accounting and operations of an entity based off of what management requirements, okay? And who carries out an internal audit? They're referred to, it is being done by people that we call internal auditors. Now, who are internal auditors? They are staff of an entity. They are not like external auditors that act independent of the firm. An internal auditor is a part of an entity, is it reports to management. Okay, so that's one thing to separate or know about the difference between an internal auditor and what an external auditor. Okay. Now we're going to the next one that says, what are the reasons for developing internal audits? You know, I told you that it is not compulsory, right? So if it is not compulsory, what are the reasons why organizations still put in the level of resources just to have an internal audit team? So the first one we have is that it helps management to monitor the controls within an entity. Like I was telling Omotayo. Omotayo, is your surname Omotayo or your name is Omotayo? I want to be that Momo is your
My
surname.
name is
So I was
Omotayo.
telling okay. So I was telling Omotayo that when you put in place internal control and you don't do any follow-up of that internal control, it is just like having rules or putting instruction in the document and leaving the document in the store. So internal audit is what helps management to be able to monitor the control that they've put within an entity. The second one is that entities need to become competitive by putting their resources to effective and efficient use. So this your internal auditors, unlike your external auditors, they are inside the firm day in, day out. They see what your process is like. They are able to tell you that, oh, we need to cut down on this. We need to increase our budget on this. Oh, personnel is already acting this way. Our staff turnover is getting high, than leaving it till the end of the FY for the external auditor to come and make comments about it. Do you understand? So it's because it is done in a more frequent way, or the reviews are more frequent than an external audit. It allows you to be able to make sure that your resources are being effectively used through what we call a value for money audit that we'll talk about as we move on further. And the third one, we said that it is used by management to check on compliance with laws and regulations. So in your types of internal audits, we have what we call compliance audits. Now, this compliance audit is put in place to check for what? To check that laws and regulations that are being set up are adequately being what? Followed. That is your what? That's another reason why your internal auditors exist. In some entities, they even separate their units. They call some people internal audit department, and then they call some other people compliance team. Okay, so the compliance team, because entities and their different industries have different regulations. If you're in telecom, if you're in aviation, if you're in oil and gas, the regulation or the level of regulation in those kind of entities are obviously higher. And because of things like fine, you don't want to be on the side of the government, or you don't want to be found on the bad side of the government. So they place a heavy level of reliance, or not reliance, a high level of demand on their compliance team, just to make sure that all the regulations are being followed. The third one we have is that it can be used by management. No, but the fourth one is specialized internal audits can assist management to review the effectiveness of controls within the IT system by means of its audit. Now, you know that when we're okay, so moving on. So when you are doing your external audits, the way it works is that those people are doing the normal stereotype audits, right? Test of controls, checking your financial statement and making sure that what it is in line with the proper regulation. Okay. However, However, the way it works for your internal audit is because they are your staff. Okay, I can say, Omotayo, this our website, we need to review it. Let's check. Are we susceptible to fraud? Abi, what's the level of web trust that our customers have? What are our competitors doing that we can do better? What is the integrity of us? Like, what's our website integrity like when people put their details? Is it subject to hackers? You understand? Can hackers come to our website and then be getting back-end information? So you can tell your internal auditors to do all those level of checks for you because they are your staff, okay? But you cannot make such demand on your external auditors because those ones will come and do what? The type of audit that is required of them to do. So just to summarize it, what are the reasons why we develop internal audits? Knowing that it is not a compulsory function. Number one, it helps management to monitor the controls in the entity. It's not just to put the rules. Are the rules being followed? Number two, it helps to ensure that the entity is putting their resources to effective and efficient use. Okay? Number three, it helps management to check on compliance with laws and regulations through what we call a compliance audit. And like I said, compliance varies from industry to industry, and the level of risks that is attached in terms of fines and things like that vary according to different industries. The fourth one is that you can use your internal audits to carry out a specialized audit function. You can use your internal audit to carry out a specialized audit functions where you are reviewing your IT system, which may not have been possible if you were doing a full external audit. So it takes us to our next subheading, which is the function of the internal audit team. So when you have internal auditors, what exactly is their responsibility? Number one, monitoring of internal control. So just a clue, you can get your functions from the reasons. The function of this internal auditor stem from the reason why you needed them in the first place. That makes sense, right? I've not heard Oyindamola's voice, but I want to believe that she's hearing me. Oyinda, can you confirm? And Nyedi has not said anything in the call. Can the both of you confirm that you can hear me? So I'm just sure that I'm not talking to myself. Okay, I can
I
see a
can
chat
hear you, ma.
already. Okay.
Okay,
Okay, moving
I
on. So
can
as I
hear
was
you.
saying
Sorry,
that,
my name is
okay. Yes, I can hear you. Okay. So I was saying that you can stem the functions of an internal audit from the reasons. So number one, the first reason was to monitor control. So what's their function? They have to monitor the control. So we said internal audits are usually given specific responsibilities by management for reviewing internal controls, monitoring their operations, and recommending improvements via a report to directors or to those charged with governance. Like I said, so the way it works is that they do report. So it depends on an entity. So most entities you do like a monthly report, okay, to management on recommendations and areas of improvement. Now the way it works is that management can choose to take your recommendation or they may choose not to take it. You cannot beat them. You understand? So even the recommendations they give to management is still subject to management wanting to apply this recommendation. And that's the downsides of like being an internal auditor. Number two, examination of financial and operating information. This is a core of what internal auditors do. This may include review of the means used to identify, measure, and classify. And this includes review of the means used to identify, measure, classify, and report such information or specific inquiry into individual items, including detailed tests of transactions, balances, and procedures. Work in this area is very similar to that is carried out by an external auditor. So it's almost like audits, but you are taking a deep dive into their financial and operating activities for that month. Just basically doing your own review before the auditor comes. Okay, then the third one we have is review of economy, efficiency, and effectiveness. They are called the three E's. You guys are skill students. I want to believe you are doing PSAF as well. So economy, efficiency, and effectiveness is also called value for money audits. Value for money audit. So when somebody says they are doing a value for money audit, that means they are checking the three E's, which is checking for economy, checking for efficiency, and checking for effectiveness. What is economy? Economy means doing things that will not normally we used to say cheaply, but I would say doing things in the most economical way, in the most cost-saving way. So every service that we engage people on, or every raw material we buy, or every outsourced service that we have, are we sure that we are getting that service at the most cost efficient price? You understand? So that is economy. We call it, if you were in ATS3, I would have said doing things cheaply. If efficiency means doing things well on an input output basis. So if you want to check whether your process is like efficient, let's say it's a manufacturing firm, you are checking their raw materials, you're checking their level of waste, you're checking the products, that the number of product defects and things like that. That is efficiency. That's okay. As an entity, are we efficient with the resources, with the resources that we now have? Some people can, like, I always use this joke so that people can remember efficiency. So somebody can make one spaghetti, one golden penny spaghetti, and it's where they will cook it is to feed 5 people. Another person can make spaghetti. Some people tell that they don't like spaghetti so soft. And then they make spaghetti to be so hard, but it will be so small in the pot. You're like, is this a whole spaghetti? Yes. And in this case, it may be sweet, but it's not efficient because in terms of the level of inputs and level of output, right? It may not be equivalent. That's not what we're using, but just so that you can proper image of what efficiency look like. Efficiency measures output. Now the third one is effectiveness. Now, effectiveness means doing the right thing. Okay? So economy, doing things cheaply, efficiency, doing things well, effectiveness, doing the right thing. Now, when we say effectiveness, we are looking at the process in which the activity was completed. Peter Obi said, if somebody will be called your excellency, the process as which you were elected must be excellent. But that's just what you are saying not ineffectiveness. Ineffectiveness, we're saying, okay, some people want to cook jollof rice. When they want to make jollof rice, or some people want to make stir-fried spaghetti or jollof spaghetti, they'll fry all the sauce, they will even parboil the spaghetti, sieve it out so that the one that has starch can go out, and then now turn the spaghetti inside, now start stirring it small, small. That's a way to make spaghetti. But if anybody hear that you have ever eaten spaghetti when you're hungry, the moment you put the paste, you put everything as it is cooking, all of that, the moment you just boil like this, you just pour water inside the spaghetti, you break the raw spaghetti from the nylon, abi, inside the water, straight. And that kind of spaghetti, you don't need to open it till it's done. Then, abi, did I lie? Now, did the spag not done? Once you most likely eat the spag that way. Please, I like me an interactive class, so I am using all my
With
last
you.
energy to teach you. So please respond to me, please.
All right,
So
so I'm
the
with you.
two spaghettis, yeah, these two spaghettis, then they get ready. Won't you eat it? You eat it. But if we are looking at the effectiveness of the process, you will see that one process was more effective than the other. Okay, so that is effectiveness. Now, effectiveness, they'll tell you that when you are checking for effectiveness, you are checking that the objective you wanted this thing to achieve, did they achieve it? So it's not just about eating food. Were you able to sieve out the starch? Are you sure that you are eating food that is has the proper nutrients? Is the process of the cooking, is it clean enough? Hope it's not even causing more harm to your body, literally. That's what they're trying to say. So basically, your internal your internal auditors are also carrying out what we call a value for money audit, which is what checking for the three E's, which are economy, efficiency, and what effectiveness of operations. Now, the fourth one is review of compliance. I told you that all their function is coming from the reasons why we set them. So review of compliance. So you can use your internal auditors to be your compliance team as well, where they are the ones that will be responsible for checking for compliance with laws and regulations, uh, and checking for compliance with management policies, management directives. So that's the thing. I told you that if you just set rules and there's no like check to ensure that the rules that you set are being followed, then it is as good as you not setting the rules at all. Yeah, so that's his review of compliance. Now we have special investigation, and that was the last one we talked about, that you can use your compliance team to do investigation into specific matters that you may not be able to narrow down if it was a big external audit. You understand? So if it was a big external audit, you cannot tell your auditor that, oh, there's this particular thing, I'm thinking there's a fraud there, go and check it. Auditor will tell you that, okay, if it is part of the samples, you check it, but it's not under any compulsion to test a transaction because you have showed interest in it. However, because these people are your internal auditors and they are part of your officers in your entity, you can use them to carry out investigation into particular areas. The majority of these activities here will be classified into like operation internal assignments, where investigation will be done and then you do like a report to those that are charged with governance. Now, a major subhead, and this is like an ICAN question where ICAN just used to put in place so that students can pass. And it is the difference between what external auditors and internal auditors. So from the few things I've said, who wants to tell us like one difference between the both of them? Just one, so that we can move on. Yeah, just one difference between the both of them.
The internal audit is within the company, while the external auditor comes is at the end of the financial year.
Okay, that's a good, but that's one of the things. But okay, let's see when they are asking an exam. Now, you're already a skilled student. When they ask you for difference between something and something, one thing that you must establish is the basis. So, as you have this table, before you put this number one number, or after you put the number one number two, you should have basis. So they already outlined the basis here. So based on their role and their work, the role of an external auditor is to express an opinion as to the truth and fairness of the financial statement. However, the role of the oh my God. However, the role of the internal auditor is to examine the financial system and control and assess the risks in order to now make recommendations to management for improvement. Like I told you, these recommendations may be adopted or they may not be adopted. Number two, qualification to act. Every person that is acting as an external auditor must be set out by statutes. That means that you must have met the requirements to be called what? An external auditor, and you must be somebody that has been certified to practice. You must be qualified or certified to what? To practice. However, there are no statutory requirements for what? For internal auditors. Anybody, you can even call somebody that is did chemistry, train them in the type of checks that you want them to do, and then those people will be your what? They will be your internal auditors, because there's no statutory requirements when carrying out an internal audit. The third one we have is appointments. Now, an external auditor is appointed by shareholders. When we did our regulatory framework, we talked about the three ways in which you appoint your auditors. The first ones are being appointed by the directors. If a company does not have auditors in like 6 months after their incorporation, the registrar of the CAC can appoint. And the third one is the continuous auditors of an entity are being appointed by the shareholders in an annual general meeting. So that clarifies the appointment of external auditors. So, however, internal auditors are being employed by management. So the way they put a job requisition out there and everything like that, that's the same way to work for what? For your internal auditors. They are basically, like I said, officers of an entity. And they cannot claim independence from the organization. They cannot say, oh, this report that I'm sending this organization is independent of who I am. You are part of them. Also, we have their duties. The duties of an external auditor is set out by the statutes. So under CAMA, there's a section of CAMA that talks about the duty of of your external auditors, and their scope is also set out by CAMA, but may vary based on the engagement. However, for your internal auditors, um, their duties are being set out by what? By management who appointed them. Okay. The report of an external auditor does a report. Who does he address the report to? He addresses it to shareholders and to members of the company at the AGM, at the annual general meeting. However, the internal auditor's report is done to the highest level of management, or people or those that are charged with governance, or the audit committee. So it depends on the corporate governance of the firm that determines like who will send it to. But on a base level, he does a report as an internal, like the internal audit team does a report, and then they give that report to who? To management. So do we have any question to this point? Any question? Something that I'm not seeing here. Okay. Something I'm not seeing here. Okay, I'm with you. Any question to this point, or should I continue? Okay. Now, under the types of internal audits, just so you know, there are like 3 types of internal audits. So based on their function, they have financial and operational audits. And why are you on my screen? So we have the words financial and operational audit. So yes, just like we said, they are supposed to review the finance and operations. So yes, we have financial and operations audit. Number 2, we have what? Compliance audits. Okay, we have the compliance audits. So those are the 3 audits. They do finance audits, operational audits, and what? And compliance audits. Okay, so those are the 3 types of internal audits that audit departments within an entity are required to do. Now, this chapter is sort of divided into 2 in the sense that they also have a part of the chapter that talks about outsourcing. Now, when we started this class, I said that the internal audit function is not a compulsory, it's not a compulsory function. It's not a statute. Not let me I stop using the word compulsory. It is not a statutorily required activity. So because of that, most entities see it as like a sort of repetitive tax, and they usually want to outsource this service to like an accounting firm or to an outside entity to carry out this activity so that they can focus on like other core management function. Okay, so now we have outsourcing internal audits. Now we have here that outsourcing involves the transfer of management the outsourcing of internal audit refers to the transfer of management day-to-day execution to an external service provider. The main reason for outsourcing internal audit functions include number 1, technical expertise, managing costs, and based on the company's size. So let's use an example. A major example is growing up, when you have functions in your house, who cooks? All the wives of the house, Abby. They'll call everybody will have to cook and everything, everybody's busy. But in recent times, when you have functions in the house, who cook? They can just call one Oloko, Abby, and then everybody is good to go. So that's to tell you that the same way when it comes to the services that are being carried out by external auditors, because of cost, because of level of expertise, that's how one of your uncle's wife that used to cook whatever she chooses in her house will now come to the party She'll be telling you that, no, the jollof rice should not do like this one should not do like that. But because the people you are calling are like experts in this field, you are kind of assured of the quality of food that will come out from the kitchen. So number one, we have technical expertise. Number two, we have cost. So organizations may not have the resources to set up a whole unit and call the unit internal audit unit. So they rather just want to outsource that service outside. The third one we have is the company size. A smaller company may need the service of an internal auditor, but they may not have a permanent basis for that function. So they'll just want to, call somebody that can help them get the work done, okay? And then pay based on the need. You understand? Let's say they is a small firm, but they have an heavy project for that period. So that's one of the ways that they can manage such. What else? What else? What else? Yes, so those are like the reasons why an entity will just want to outsource their internal audit function. So because they want to have access to like technical expertise, up-to-date technology. If let's say you outsource that audit function to like a big four, right? What will happen is that big fours have like the level of resources, up-to-date technology that you may not have. Okay, so now what are the benefits of outsourcing? Why would you want to carry out a service and outsource it? Now, just to note, here we're talking about outsourcing as per outsourcing internal audit, but hope we know that internal audit is not the only thing we outsource. Yes, people outsource taxation, payroll, administrative function, security, logistics, okay? Taking out aspects of your business that are like routine and like everyday that can be given to another entity to carry out that has a certain level of expertise, just so that you can focus on your core activities. So what are the benefits of outsourcing? Number one, staff recruitment. They will not be need to recruit the staff, now start training the person, having to pay pension for the person, having to do other employee benefit and all of that. Because that person is not your staff, you don't have to think about any of that. Number two, we have audit skills. The outside service provider is likely to have a specialist staff that's such as computer audit expert. These internal auditors will have the internal auditors with an IT skill may be difficult and expensive to recruit as full-time employees. So we said we wanted people that could do specified type of investigation and audit. So people that will have that level of experience, they may be expensive as full-time staff, but if you outsource it, because that firm will have different type of auditors, they may have experts in that kind of audit. Number three is confidentiality. The internal auditors provide the internal auditors, okay, sorry, cost and flexibility. The cost, you may be able to get a reasonable cost that is lesser than having to set up a whole department, buying chair and table, doing onboarding, giving the person employee starter pack, just get somebody to do the service. But it's not all the time that it's cheaper. And also flexibility. You can say, oh, we want you to come in 3 times a week. You can tell them that this is a specific need that you have. So all of that variableness can be available in when you're outsourcing a service, because you are a client and they want to treat you as such. Then we have the quantum of audit work. Outsourcing may be economic for a small entity that does not have enough audit work to justify full-time audit team. So we already said that before. So let's say they don't even have like everybody in the entity are just 7. We now want to set up a whole internal audit team. It may not work like that. So next subheading after the benefits. So what are let's summarize the benefits. You don't need to recruit a staff, access to audit skills that your internal auditors may not have, or you may not be able to afford, cost and flexibility. Be, you don't need to look for a whole new staff just to be able to apply this change. So now what are the problems of outsourcing? Number one, changing of personnel. People may leave the external firm. People, all the accountants were very mobile. Before you know, this person has left, person has, after knowing your processes and all of that. So number two is the cost. The accounting firm could charge like very high prices because now we're just running our mouth, so it may be cheaper, it may be cheaper. Sometimes it's expensive, like crazily expensive than what you would have ordinarily had to pay for that particular service. So that's also another problem. Negotiating may not put it as cost. You may say negotiating a price may be rigorous. Okay. Number three is confidentiality. See, the thing is that the moment you carry your matter and put it outside, you cannot say how far it will go. So the moment you expose your data to an external party, it's not a bad thing, but in this case now, to be your auditors, to be your internal auditors, you must make sure that their own system is also leak proof. Like, okay, their system also there to act, and then they can carry your information and be putting it to outsiders. Then we have control. An entity may not have the same control over its internal auditor's work if it is outsourced. And that's why a lot of tech guys don't want to work in the bank. I'm sorry, just to ask. Um, Omotayo, are you still with me?
I'm with you, man.
Okay. So because of this control factor, that's why a lot of tech guys don't want to work in bank, or they don't want to work in like very structured firms, because what's the thing about being a tech guy, being able to work from home, having a flexible work structure and all of that. And that's what people want to get when they like employ an internal auditor. You just want somebody that as your back and call. But the moment you outsource your internal audit service, person will tell you that, okay, this report will be ready on Friday. And you're like, today is Tuesday now. Why are you saying I should wait till Friday? The person is like, I have other things I'm working on. And because person is not in your payroll, you cannot tell the person that, what are you working on? Leave it and work on my own. Because I mean, before you engage that person, you already knew that the person works on like multiple engagements. Okay. So that is another thing. Then we have conflict of interest. This one is, sometimes you may outsource your service to a firm um that is auditing is is auditing maybe your competitor, or there's a likelihood of conflict, like threats to independence. Maybe there's a level of familiarity, or there's a level of familiarity involved, or the reason why they've accepted to be your internal auditors is because they also want to carry out other type of, they want to use to enter your firm. You understand? And okay, we'll be doing your external auditors too, or we'll be doing your taxation too. So it may lead to like conflict of interest, because all these firms, they will just want to say, oh, who are our auditors? Let's just use our auditors to do this internal audit. But imagine that the same people that are your auditors are also the same people you outsource as your auditors are also your internal auditors. Okay? Yeah. So that is it about the problem. So changing personnels, negotiating a cost, ensuring confidentiality of your information, level of control that you may not have simply because you have now outsourced that activity, and then the quantum of work that because okay, sorry, changing personnel's, negotiating a price, confidentiality, having full control over that staff, and also conflict of interest. Now we have the internal audits and risks assessments. Okay, so here, my God, sorry. So here we're talking about this internal this internal audit is, like I said, is just to reinforce control. Okay, you have put in place all those controls for your entity. So internal audit is to reinforce control. So these internal controls are put in place by directors to make sure that the entity is meeting up with its corporate governance goals, right? And basically one aspect of control is like management of risks. So risks are just deviations, things like fraud or error, right? So the way it works is that risk is extremely relevant to the internal auditor. His work may often involve carrying out risk assessment exercises designed to identify main areas of risks to which an organization is exposed. The internal auditor will report these risks to management and will prefer and would perhaps make suggestions of how these risks could be managed. Okay, it is useful to say that the analysis of these risks are done in three main categories. So what are we trying to say? We're trying to say risk management is a management for risk assessment, and the management of risks is a responsibility of your directors. So a core of what your internal auditors are doing is basically managing that risk before it goes out. So they're saying that when internal auditors are doing reports, they'll do these reports into like three main categories. They will talk about all the things that are affecting their operations, things that can lead to disruption in their operational activities, so operational risks. To talk about everything that can disrupt their finances, okay? Things like their gearing ratio, their credits, their turnovers, you understand, and all of that. So they'll talk about their report to management will contain everything that can basically lead to what? A disruption in their finances. And the third one is what? Compliance risks. These are risks that the entity may fail to comply with relevant rules and regulation, resulting in penalties being imposed by regulatory authorities or fines being paid to injured parties. Examples of compliance risks may vary according to the nature of a company's activity. They may include risks of non-compliance, such as health and safety, anti-pollution, employment, etc. Just for context, I know somebody that's worked in like compliance of a telecom, and there was one that they just realized that there's a particular law they've not been following, and they were subject to, I think, over 100 million naira fine. So the person was working with the compliance team, and basically they themselves they just took their self meant to report themselves to the appropriate authority. And when they got there, they said that the director of the authority just showed them a document that, see, we're already complying, we're already sorry, what is complying, compiling you people's fine. Like, we're ready to come and storm your office very soon. And if we're the ones that came, we already had in mind to charge you over 350 million um for this rule that you were continuously breaching. And then they were like, oh, they didn't know better and all of that. So compliance is actually a very big deal. Like I said, it varies according to industry, but ignorance is not like, they won't do ignorance like, oh, you didn't know, oh, so nothing should not happen. Okay, so moving on now, when it comes to management of these risks, there are like four ways. Number one is acceptance. So we call it the Tara model. Okay, we call it the Tara model. So the Tara model talks about four approaches to risk management. So we said in many cases, it is not possible for management to eliminate risks entirely. Instead, measures are taken to manage the risks. Now, so what are the measures? Number one, you can limit the probability or the adverse events, like you limit the probability of an adverse event occurring. Like all of us, we basically every day we open up ourselves to risks. I was asking somebody that like works in where does she work? Like a gas station. I was like, this is such a risky job, that why you do this kind of job? And she's like, all of us, we're all in risks. We are just in the office because you have chosen the lesser risks than I've chosen. So that's the thing. So companies now, they may not give out credits above, maybe if a company is already owing them 30 million plus, they may not give you new goods again. Those are just like ways that those are just like practical procedures to just reduce their financial risks. or they can limit the impact of the risk when it occurs. And limiting the impact of the risk is like using things like insurance or just moving the responsibility of the risk when it materializes. That is what um limiting the impact is. So limiting the impact is this risk will materialize, but how can I make sure that when it materializes, it is not my responsibility to do? So that is what transferring the risks or moving the responsibility of that risk to another party. So the approach we have is called the Tara model. The approach we have is called what model? The Tara model. So Motayo, can you just read this for us so that I would explain?
Acceptance,
Okay.
reduction, avoidance, and transfer.
Mm-hmm.
Risk acceptance means
Mm-hmm.
accepting the risks and doing nothing to reduce the possibility that an adverse event will happen, and
Okay.
doing nothing to limit the consequences if any
Okay.
adverse event does occur.
Okay.
While reduction, risk reduction involves taking measures to reduce the probability that an adverse event will happen or reduce the consequences of an adverse event. Measures to reduce risk may involve instituting appropriate control to minimize the risks to which the entity is exposed. Most internal
Okay.
control are designed as risk reduction measures.
Okay.
Avoidance. Risk avoidance means avoiding transactions or situations that will create an exposure to a risk. For companies, it is normally impossible to avoid risks entirely without withdrawing from a business operation entirely.
Mm.
While the last one, transfer,
Transfer.
risk transfer means transferring the risk to a third party, often in return for a payment. The most commonly used example of risk transfer is probably the use of insurance. With
Okay.
insurance, risk is transferred to an insurance company in exchange for the payment of a premium.
Oh my God, thank you. So, um, thank you. So the reason why I wanted you to read it is because even when you read it, you see that it is actually direct. The interpretation is direct. It's not something that somebody needs to come and over explain before you understand. Okay? Alright. You don't know that somebody needs to over explain before you understand. So the first one we talked about was acceptance. So there are some level of risks that you cannot run away from. So like operational risks, oh, you get to the office, one switch has spoiled, and everything like that. They'll tell you that those ones are like operational risks. Their likelihood is high, but the impact is not very high. So you cannot see like an operational risk that you cannot see like, oh, is it because switch did not on that you people will not run your business for that day? No, okay. So that's the thing about like some level of risks. Risks that their likelihood is high, risks of your staff leaving, things like that. Their likelihood is high, but the impact of those risks is what is small. Okay, so for those type of risks, you actually most times entities just do well to accept them or put in place like smaller procedures or I said smaller procedures. They put in place like policies and yeah procedures to just reduce the effect of that risk materializing. Okay, then we have reduction. So reduction are like risks um that you are putting in place controls to minimize the risk when the entity is like exposed to it. There are risks that okay, it is things like carelessness that lead to it. So it is just um ensuring that you have controls in place and that these auditors are now checking that these controls are being followed. Okay, so when you put in place procedures to reduce your risks, what happens is what we call residual risks. So residual risks, they say residual risks is the risk that is remaining after all effort has been done in mitigating against a particular risk. Okay, that is residual risk. So residual risk is like, for lack of a better word, like remnant risks. After you have put all effort to reduce a risk to a minimum extent, the risk that is still remaining, like even if you say, if you go to a supermarket now, one thing they used to do is that the person that collects money, the person that sells the goods to you, is the one person that collects money. You understand? Or even if it's self-help service, the person that you give your card to is even that guy at the sorry, it's different from that guy at the door, Abby, that collects your receipt and like make sure that you have payment receipts and then you have the one that was brought out from the machine as being verified. So that's like a procedure that has been put in place. Okay. So, but you still get residual risks because I know that when they start doing that, those people that used to search or check the receipts, you have to open the nylon for them to like check that, okay, the things on the nylon are the things that you actually bought. Who remembers? Was that not what they used to do? They will
Yes,
open the
ma'am.
nylon to check that, okay. Eh?
Yes, that's what they do.
Okay. But in recent
And
times, do they used to open the nylon as much as they used to at the beginning? No. They'll just
no,
collect the nylon, they'll just squeeze it. So they still you can see that even if there are procedures to reduce these risks to a large extent, um, these risks are still what? They are still materializing. Okay, so that is risk reduction. Now we have avoidance. Risk avoidance means avoiding transactions or situations that will create an exposure to these risks. So it is just like, and that's what they said, that you cannot avoid the risks. You cannot totally avoid the risks except from not engaging in activities that will even open you up to that risk at all. Like that's the best way to avoid the risks. Not engaging in any activity that will open you up to that risk at all. That is the best way. So if you are saying that you don't want flood or don't go and collect building in the island, you understand? If you are saying that maybe a particular business, it involves like foreign exchange and things like that, and you're saying that okay, you don't want to expose yourself to you don't want to expose your company to exchange loss and things like that, what will happen? In this case, you have to stop that business unit because that is the only way to totally avoid a particular risk. Hi, Chioma. Good afternoon. Then the last one we have is transfer. And under the ways of limiting the impact of an adverse risk, when you are transferring a risk, what you are basically doing is moving the responsibility of that risk to another party. So transferring a risk is to say, if there is a theft, simply because I have gone to insure our entity against burglary and theft. If what happened is a theft, insurance company will come, collect all the evidences that they need to, and let's call it a restituto integrum. Yeah. So they will restore you back to the way you were before that particular risk materialized, simply because you have transferred the materializing of these risks to another party. Okay, so are we together? So that brings us to the end of, hey, can you guys hear me? Just got the prompts that my internet. So let's just
yeah, I can
check
hear you, but it's breaking somehow, somehow.
for
So.
a few past questions. What are you speaking, or did you lose me for a bit?
We
Okay.
lost you for a bit, but no problem.
Yeah, I got the prompt that my internet was unstable, so I was asking. Okay. So here they were asking that explain how the internal audit function helps an entity with the risks of fraud and error. So you explain how fraud and error is a management function, and because internal auditors are like officers of that entity, in their reports that is more frequent than um and external auditors reports, they'll be able to talk about risks that the entity is being faced with, either operational, financial, or compliance risks. And in by carrying out a detailed examination of their operations, they are in a better position to pick instances of fraud and error than an external auditor. Okay. Then they said, explain the responsibility of an external auditor in respect to the risks of fraud and error while auditing a financial statement. Let me ask you in this class, are your external auditors, do they have a responsibility of identifying fraud and error? Your external auditors.
No,
What kind of objective is it for them?
they come and check,
So,
they do test. Okay,
your
ma.
identifying and assessing fraud and error is a secondary objective for your external auditors. So it is that I don't come to your entity looking for fraud and error. But if in my audit I come across fraud and error, I will point it out to you. But the essence of my audit is not for fraud and error. Do you get? So that is the external auditor's responsibility when it comes to what fraud and error. So let's read this question. Rock Holiday is an independent travel agency. It does not package holiday itself. It takes commissions on holidays sold to customers through a chain of high street shops. Staff are partially paid on a commission base. Well-established store operators run the holiday that Rock Holiday sells. The network reservation systems through which the holidays are booked and the computerized accounting system and the com- and the computerized sorry and the computerized accounting systems are both well-established systems used by many independent travel agencies. Payments by customers, including deposits, are accepted in cash and debits and by debit and credit cards. Holiday is legally Rock Holiday is legally required to pay an amount of money based on the total sales for the year into a central fund maintained to compensate customers should the agency cease to should the agency should wait to compensate customer if the agency should cease operation. Describe the nature of risks arising from fraud and error which Rock Holiday is subject. This is a sweet question. You have to analyze the question. So let's say from the beginning, they said they are a travel agency. The first thing we see is that there is a there is a business risk in itself because the holidays they are curating is not their own, right? They are booking the holidays from well-established like chain of street shops. So if those shops stops operating, the going concern is basically dependent on the existence of another entity. That's one. Number two, you can see that they are collecting deposits by cash. And anytime you hear that anybody is doing anything that involves cash, there's already a financial risk that is involved. Abi, theft, not reporting and income received, um, overestimating amounts received or things like that, simply because you are receiving what? When you are receiving cash like this, there's a financial risk that automatically comes from receiving cash. So they said Rock Holiday is legally required to pay an amount of money based on its total sales to a central fund maintained to compensate its members if the agency should cease operation. This is a good one. It's not really a risk, but you can talk about how they are already mitigating against the risks above, that business risks that we talked about, that going concern, that the one that affects going concern, because them just at least putting money, that means they are transferring the risks more like a form of insurance, that if the agency should close down, their customers will be able to get their money from here. So this was when ICAN still used to do giveaway. So let's check November 2016 question 1. We'll just do about 3 of them, and then you can do the remaining by yourself, okay? So they said, state and explain the purpose and functions of an internal audit in an organization, 5 marks. So Damilola, is this something you want to answer in Yedi or Motayo? This was very direct. We did it in this class. Purpose was the first thing we did, and then we talked about their function. Oh yeah, I'm waiting so that we can continue.
And the function monitoring of internal control. That's
Mm-hmm.
the function. An examination of financial and operating information.
Yeah, then they are reviewing economy efficiency and effectiveness of operations, and then they are reviewing
Of
compliance, and they
compliance.
also carry out special investigation. So they ask purpose and function. Explain the
5
purpose
marks.
and the function. So you first, yes. Is it
Okay.
too small?
It's small.
It's too small. Oh yeah, now. You know that all these diets, they are even Odo diets. This is 2016. That's almost 9 years ago. So they said
Hmm.
enumerate the difference between an internal and an external auditor, 10 marks. This one is very simple.
Role.
The difference between internal and external auditor, is that not the table that we
Yeah,
just did here?
yeah, external auditor role and work is there to express opinion. The external auditor is to express opinion, the truthfulness and fairness, while the internal auditor is appointed maybe by management.
So just remember the bases. So what are the bases? Who said what's their role? Do they need qualification to act? Who appoints
Who
them?
appoints them
Who sets their
and their
duty?
duty,
And who do they
and who do
report
they
to?
report to?
Exactly. If you remember the basis, you remember the question. That's it. And this one is not small mark. Oh. This is a question mark question 1. Oh, that's 30 marks question. This one is 10 marks. Then they said
This is
present
a
the
30
reasons.
mark question. Okay.
Yeah. So they said present the main reasons for outsourcing internal audits. Oh my God. The main reason for outsourcing internal audit, which is what? Technical expertise, cost, and company size. 3 marks. Benefits of this one, they just ask the whole chapter. This is a giveaway diet. Benefit of outsourcing, staff recruitment, audit skills, and what? Cost and flexibility, quantum of work. How many marks? 2 marks. Problems of outsourcing, 4 marks. Before I even go here. Indeed, I've not still heard your voice. So, Chioma, I greeted you when you came into the class. Taja
Yeah.
Tenron, you did not answer me. Hmm?
I
I'm
think
using
they just smooth themselves.
ah,
So
I'm
they
Hi,
just
using
want to be
Christiana.
my
heard.
Sorry, I didn't hear when you said hi. Good morning or good afternoon.
good good afternoon. When you joined the
Oh,
class, I first
sorry.
said good afternoon. Yeah, I now
Sorry, good
said that we
afternoon.
have been doing questions. You people are just looking at us that whatever they want to do, let them do.
No, we're
Abi?
learning. Like me, I'm learning. I don't know all these things, but then I'm learning. Thank you.
Oh, okay.
Because I
Um,
did join, I was on and off at some point in class because I was in transit. but I'll go through the
Okay,
recording later.
okay. But are you in practice? Are
No,
you
I'm doing
are
something
you,
completely
huh?
different. I'm doing
Okay, are you
something
something
completely
for?
different.
Okay,
Yeah.
so please, you need to pay attention, or you need to pay attention to
Okay.
this thing. Yeah.
Okay. All
Okay.
right. Thank you.
Thank you for responding.
You're welcome.
Winda was using the chat before, so let's just assume that she cannot speak where she is. But yeah, so problems of outsourcing. Now let's ask you guys that before we even go to the material. But we did it in this class. Changing personnels, negotiating a cost, um, the issue of confidentiality, um, control, you can't control somebody that is not your staff. You can't control the pace at which they will work. And then we talk about conflict of interest, how they may be working with with your competitor, or the reason why you have outsourced to them is because you people have like a level of relationship, and that breaches familiarity, right? That breaches your principle of like independence, that says that you should not have like too much familiarity. So yeah, so the last one we'll do today, um so let's do November 2017 question 2. So I've outlined it for you, so it will just be easy for you to go to the past question and just like search for the questions. Okay, so they said we should describe the term value for money audit. This one is very simple. Let's not waste time. What does value for money audit means? Ha. We did it in this class, so oh yeah. In DD, what's value for money
Now,
audit?
when did we do it?
When did we do it?
I don't forget.
Omotayo.
Oh, I've forgotten. I
What are
forgot.
the three E's? What are the three
Okay,
E's?
efficient economy,
Uh-huh.
efficiency,
Uh-huh.
and effectiveness.
Mm. Okay, oh. That's our students they will come and say, they didn't teach me. Hmm. I'm still here, oh. You say, when did we do it? Identify and explain the component of value for money. So explain them one by one. Abi? Then what are the challenges? The challenge is some people tell you that, okay, those three is alone, they are not enough metrics to use to know whether value for money was gotten. You can talk about the fact that doing things economically may automatically just reduce the value, or it may not lead to getting premium service for that particular thing that you have done cheaply. People talk about efficiency, that's okay because you are managing output, because you want to have like a lot of outputs. Are you sure that you are not doing substantial production? You understand? Or you are not overstretching your employees. In this case, if we're talking about services, and then efficient and effectiveness, they are like, okay, the goal that is being set up, if it is being achieved, that means the project is effective, and what effectiveness means to different people may vary. Okay, the external auditor
Do we
may
have a
rely on
topic,
the work.
a standing topic
Huh?
for this? Sorry, man.
Huh?
Sorry, man. Do we have a standing topic for this? This,
The main topic, I don't understand. What
as
you
in,
say?
is there like a topic that really talks about this value for money, or we'll just
No,
use it from?
you do value for money more in your PSAF. Do you understand? It's like a PSAF thing.
Wow.
More of government agency do like value for money. Here, it was just a side conversation. You understand?
Okay. Okay.
It's not like a, how will I put it? It's not a
Topic.
core aspect, just a hair. So it's a case of, is either you know it or you don't know it.
Hmm.
Hmm. Mm-hmm. So they said the external auditor may rely on the work of an internal auditor to obtain this one is audit evidence. Okay. So yeah, those are like three questions. It's a short topic that's in over, at least we are treating from no, November 2014 till date, and it has only come out like 7 times. So um that's in over how many years? Over 12 years now. So you want to over 12 years, that's like 24 diets that's come out 7 times. That's like a ratio of about once in every once in every 4 or 3 diets, Abby. So you want to know how to read it, answer the if you are as we're on this call, as I leave you, it's a short topic. You can literally you have this material. You can just sit down and read through the material, answer the remaining 4 questions. If you have any question, send me a message. I will answer you. You understand? So AAF is not hard. The questions that they even set, even in the exam hall, is not hard. If you sit down, treat all your past questions before you enter the exam hall, the likelihood of having issue with audit and assurance is very, very slim. Okay. So definitely we are meeting next week. I traveled, I was in Lagos last month, so that's why I think we only met once. Our class, I don't, I'm not even sure we met at all because I was usually on transit on Thursdays. But yeah, I'm back. Nope, thank God. So I'll just see what happens if we can have multiple Thursdays, but I'm not scared at all. We'll still be able to finish up in record time, so there's no problem. Okay. So we'll see in our next class. Our next class will treat audit planning, a very, very important topic. So we'll hopefully, definitely we'll do that on Thursday so that we'll have a fuller room. Yeah. So don't know if anybody has any other question. Any questions for me? Oinda, Chiso, Enyedi, Omotayo? Any questions for me?
None, ma.
Okay,
From my end,
okay,
none, ma.
From me, I'm good.
okay. So thank you very much. Thank you for taking time out of your public holiday to sit with me that did not engage your class yesterday. I'm very sorry. I sincerely apologize. Okay,
Oh,
welcome to class, Doib, but we're already rounding up. Okay. So in the absence of any other questions, I would say enjoy the rest of your public holiday and have a great day.
thank you, ma.
Yeah, you're welcome.
So you too. Thank you.